evening, everybody. Luke Gromen, FFTT. Hope everyone had a great Easter holiday weekend and a great first day of the week. Thanks for joining for two things that grabbed my attention recently. Going to jump right in. First off, something we retweeted last week. Japan's asked to travel to U.S. April 25th for meeting with Mnuchin, according to Reuters sources. Within the article, it noted that Aso and Mnuchin may discuss provisions against FX manipulation that the United States hopes to include in a trade agreement with Japan. And so the thing that grabbed me about this is that I continue to be surprised by the lack of discussion surrounding what appears to be advanced discussions of FX deals with China and now possibly Japan, coming out on the heels of the USMCA deal last year. And I think it's important because much of what we're seeing in the stock market, what it's doing, makes sense if these deals that are purportedly about trade actually have an FX component that should, given our deficits, structurally weaken the dollar if they get done. And so that's the first thing that I'm paying pretty close attention to again this week. Second thing is that there was an article in the FT noting that foreign investors are increasingly buying U.S. bonds unhedged for currency risk. And this raises concerns of widespread losses if the dollar weakens. And I thought this was interesting on a number of levels. We talked a lot late last year, in the third and fourth quarter last year, how FX hedged yields on treasury bonds had gone negative. In other words, if you're a Japanese or German insurer or pension fund and you want to buy a treasury bond, the calculation for you is not just I can make 3% on a treasury and I can make 10 basis points on a JGB or on a German Bund, and so I just subtract the two and that's my yield pickup. You have to adjust, because most of them hedge for currency risk, you have to adjust for the cost of hedging. And in this case, the cost of hedging against the dollar has gotten so prohibitively expensive that after you hedge for dollar currency risk, you are actually earning negative yields on treasury bonds. And so from that point, if you are a German or Japanese pension fund, insurer, etc., this brings them to a decision point, which is either they can buy their own domestic sovereign debt instead of ours, which has big implications on a number of different fronts, or they can start to buy treasuries unhedged. And what this article notes is on the margin they're starting to do so. And so on one level, this is important because it is incremental demand at a time we need incremental demand. But it also suggests, again, that we're kind of getting into the later innings of this, because I don't think they're going to buy too much unhedged simply because of the amounts involved and the risk, right? If you pick up, right now, say a 10-year treasury is 2.5%. If the dollar does what it did in 2017, down 12%, you're going to lose about 5.5 years of coupon in the currency depreciation on any unhedged portion of your portfolio. And that's overly simplistic, but it gets you to sort of understand what that is. Now, importantly, most of these people most of these investors have finite balance sheets and are mark-to-market investors. In other words, if they start losing money on the dollar portion of their portfolio, they will hedge. And so the way you hedge a falling dollar is by selling dollars. And what the article notes is that, in the short run, this is good news for treasury demand. It's good news for sort of, fiscal or financial stability. However, it sets up a huge financial instability in that if you do get dollar weakness with too much unhedged treasury market or treasury buying, you could have this vicious cycle downward of hedging. You've seen this from time to time, for example, in the mortgage market, when you get, back in the 2000s, you get rates moving, you get people hedging out rates for refi risk, etc. So you would set up this vicious cycle. So I think it's a very important thing to watch if you continue to see increasing amounts of treasury. Either way, if you get more people buying treasuries and U.S. bonds unhedged, or if they reach a point and say we're not doing it anymore, then you'll have to see one of two ways to normalize hedging costs. It's either take rates up or take the dollar down. So we'll be watching that closely as well. Had a couple of questions here I'm going to run through and then jump from there. From Sans, how would the euro-dollar system likely respond to high inflation, 5 to 8% inflation in the U.S.? It's a pretty tricky question. I think ultimately you would see rates back up. The challenge is if rates back up too much more than where we've seen peaks in the last couple years, those are levels of rates that are problematic quickly for the entire system, from U.S. consumer to U.S. corporate, all the way up to the U.S. government, and that might be the most important one, the U.S. government, because they have a printing press unlike the other two sectors. And so my sense is if you had a pickup in inflation, you would have the monetary authorities have to get involved in terms of capping yields at some point. And that's been our sort of long-standing case, that you would see a 1942 to 51 scenario where at some point the Fed's going to have to pin yields at, say, 2.5% at the long end of the curve, and inflation's going to do what it's going to do. And if you own too many treasuries, thank you for your donation on a real basis. You're going to lose money on a real basis, and that just is what it is, because somebody has to lose. You either have to, when you have too much debt, you've either got to default or you've got to restructure, and that's sort of a restructuring, if you will. So that's how I'd answer that. From David, any comments on the euro dollar and why only one person seems to talk about it? I'd imagine talking about Jeff Snyder, who's a friend of mine. He's brilliant, and he spends a lot of time talking about the euro dollar system, rightfully so. And I think he spends a lot of time talking about it. He's, I think, acknowledged as one of the, if not the expert on the system, based on the incredible amount of work he's done and great work he's shared with the world. But I don't think he's the only one talking about it. You've seen Harold Malmgren talk about it. There's a number of other people talking about it. But it more around the fringes. I think he does a really nice job of highlighting how this system, which was originally a regulatory workaround, right, where in the 70s, effectively, it was you didn't have to reserve as much in London as you did in the U.S., and so more dollar lending began happening out of London, and it's sort of creating, grown into this system where you've got a whole bunch of banks offshore of the United States able to create dollar lending, but not able to create dollar-based money. And over time, the system grows and grows and grows and creates this mismatch. And when there's more dollar liquidity and less dollar liquidity, it shows up there first. And so I think Jeff's done a tremendous job highlighting the warning sign of the pressure gauges within this system. And to me, the wild card in all of this is where we stand on a transition away from this system. And it kind of ties back to the points I made, in the first point here tonight, which is there's these currency deals being negotiated. They are absolutely currency deals. We had speculated that they were when we saw Steve Mnuchin being such an important part of what were supposedly just trade negotiations. 2 weeks ago, he confirmed it. The currency part of the deal is done. We're looking at enforcement. We're looking at how to agree on what are the enforcement metrics. And so there are currency deals that could be structured that would drastically increase dollar liquidity, reduce the trade value of the dollar internationally effectively. And that can be done by fiat. It absolutely can. But it depends on the terms. It depends on a lot of other inputs. So that's how I'd answer that in terms of just, to me, I read Jeff's work every time I can get my hands on it. When he publishes things, I absolutely read it, because I think understanding that euro-dollar system is very important to understand. I also think it's important to understand the context of where we are in terms of some of these deals that appear to be taking place and the geopolitical tensions that may either ease or worsen these euro-dollar shortages. So I am going to jump in here. One last question. Hi, D. Dobell. Any significance with these smaller EU countries wanting gold in their own vaults? I think, to me, it speaks to gold moving back into the system, and I think it's supportive of there's a deal going on in the background. And if there's a currency deal that structurally weakens the dollar, you're going to have a hard time structurally weakening the dollar without gold going up. If you're trying to convince markets that the dollar is going to be weakened when certain things happen on a trade balance basis, and gold just sits there and does nothing, it's not going to be a very effective trade deal. And so gold is going to be helpful, I think, to authorities in painting a picture of a weaker dollar if that's what they're after. And so I think, if I'm a central bank, I want the gold in my own vault before then. So At any rate, that's it for tonight. Thank you, everybody, for joining me. And FFTT-LLC.com for what we're up to, what we're working on. Check out FFTT Tree Rings. We've got, like I said, great feedback on that product. Top 10 things that really grab us every week with a quick synopsis, and the feedback on that product has been tremendous. So thanks again for joining us. Look forward to chatting with you next Sunday night, everybody. Have a great rest of the week. Take care.